Dear valued investors, I hope everyone is in the middle of an enjoyable summer, one where you might be vacationing more hopefully and not checking in on the markets as much. So let us welcome in the third quarter and the second half of 2023 with open arms, wide eyes, and a laser-sharp focus. Identifying the start and stop of a bull market is always challenging, as the art of forecasting includes intimate knowledge of past markets, empirical data, and an abundance of timely analytics to increase the probability of accuracy in our forecasting. As we close the books on the first 6 months of 2023, we believe there's value in reflecting on recent months gone by. Doing so can help crystallize key learnings and help chart a course through the rest of the year. Looking back on the first half of 2023, it is probably fair to say the outcome has been a bit better than expected for the stock and bond markets, especially compared to the difficult landscape we tripped through in 2022. Maybe, just maybe, we have seen the return of the 60-40 investor with some reprieve expected in the future with lower inflation expectations. We believe this may provide an opportunity for some fixed income investors. So what major points have we learned through the first half of the year? Inflation's path is not endlessly higher. The return to some post-COVID-19 supply-demand normalcy and an ease in input costs have helped push the inflation rate down, which has helped both the stock and bond markets to bounce back. Still, strong consumer spending and a stubbornly tight job market have helped the U.S. avert a recession so far. The Federal Reserve continued to raise interest rates, but we believe as they may begin to reduce rates as early as Q4 of this year, but more likely in early 2024. Bonds look like bonds again. After enduring a generational period of weakness in 2022, bonds are back and should be considered important ballasts in a multi-asset portfolio. Given what we have noted so far, we can now focus on the second half of the year. We have seen improvement in the bond market and positive returns. And we believe there are still plenty of opportunities for both capital appreciation and attractive income generation, assuming both inflation and interest rates continue to glide lower, as we believe they will. Turning to stocks, the bull market that began back in October of 2022 is now 9 months old and has already put in some notable gains. However, with recession risks still looming, investors may consider being less aggressive with their portfolios than they were in the first half of the year. Valuations remain attractive, but early in 2023, investors, seeing through the darkest of clouds, knowing recovery would occur, were rewarded, and constructive market uptrend ensued. The S&P 500 is up 16% at the mid-year point, and the NASDAQ posted its best first half, gaining 38%. Again, in our view, the stock market bottomed October 12, 2022, and the rise over the past 9 months is the start of a new bull market. I know this sounds counterintuitive, since we had no recession, nor a Fed cutting of rates. But we had a huge decline in inflation. And we argued for most of 2022, the inflation war is the war the Fed is waging and seemingly winning. This view is supported in that our belief of headline inflation continuing to fall closer to 3%, along with S&P 500 earnings growth coming in higher than expected. Federal Reserve and market participant sentiment towards inflation expectations turning dovish. And finally, the $5+ trillion in cash on the sidelines, having fully missed the market recovery, beginning to be allocated to equities. And I'm frequently asked, is this a buy the dip market? My answer is simple: when a market uptrend is intact. If buy the dip means dollar cost averaging and buying the market systematically, then yes, buy the dip. And if you're reading between the lines here, do not time the market. That is a difficult task, and often the largest of rallies are missed. At current levels, the risk-reward equation in stocks and bonds looks more evenly balanced versus earlier this year. We have seen a push lower in corporate earnings expectations, but what if those expectations are too bearish? We also have seen some weakening in manufacturing and services indicators, and early signs that the consumer could be slowing down. This does point to the likelihood of a mild recession that we've seen in past markets. This view is also reinforced by the expectation that the jobs market could weaken modestly through the end of this year. Overall, the opportunities in the second half of the year may not be as robust as in the first half, but after a very bumpy 2022, investors should be encouraged that wading back into the market could bear some fruit in coming months. In fact, the difficulty we witnessed last year likely helps lay the groundwork for further market stabilization as we press ahead. Despite our mild recession outlook, we believe there are still definitive investment prospects to uncover. Please reach out to me if you have any questions. Stay safe and stay the course.